So welcome to our second afternoon talk. So you want to start your own studio, but where exactly do you actually start? What does it entail to start your own company? What are the advantages and disadvantages of certain company forms? And what are some of the expectations from screen agencies in this respect? What do they actually want to see? So here to walk you through all of this is Luke Henry from LDB Accountants, a preferred partner of many Australian studios. Luke, over to you.
Thank you, Jens. It's great to be here. I'm really excited to talk about this. It's one of the hot topics that often comes up for a lot of people that are just stepping out into their first foray of creating a studio. And really, there's a couple of options that are there regarding the structure, and we'll try and work our way through them and cover off some of the decision making options that are there for you. So before I step forward, of course, there's the usual disclaimer that I have to, the lawyers tell me I've got to cover my butt. So if you've got any questions, feel free to reach out at the end and then we can talk in more specifics. So there's typically three main reasons why we use companies. And companies are an interesting beast in that they're a slightly different arrangement than what you would ordinarily have as a sole trader or a partnership. Sole traders are where you are operating the business in your own name, and most people would be very familiar with that, where they've perhaps acted as a contractor, they have their own personal ABN. So that's where the business is owned by them in their own right, and any income and deductions that are incurred in operating the business are reported on their personal income tax return. A partnership is where you actually have a collection of individuals, often individuals, sometimes other entities, involved, and they're the ones that are starting the studio. That's quite common for small teams. Say you've come out of AIE as a team with a piece of IP that you're looking to further develop, and you'll often own that IP either in segments individually that you merge together to form the game, or perhaps collectively. Partnerships are governed by state-based acts, and essentially allowing you to treat the business as collectively owned, and the income and expenses are incurred jointly by all parties, and then a share of that is reported in, again, your personal tax return, although you do need to report an individual partnership tax return. So what is it about companies, and why do we see companies as the most common structure? There's three main reasons why we use companies. The first is this concept of limitation of liability. The second is the idea of an IP vehicle or IP bucket. The third, and probably my favourite, quite dear to my heart, is taxation. So I come from a taxation background, and a lot of the structures that you choose typically are driven from a tax decision. I've touched on there on the slide, you'll see that I've made mention to trusts. Now, trusts are a little bit more of a complex vehicle. We won't have time really to cover that off today, but they are an option that's there for particularly where you've got a studio that's starting up where you're expecting to be significant value. Trusts are a great way for individual owners of the company to hold their shares. You don't tend to see them operating a studio, and that's for a couple of reasons, and we'll get into that detail as we cover off why we use companies. So if we step into this idea of limitation of liability, this is sort of fundamental to why most people use companies. And when I say most people that are operating a business or looking to achieve any sort of protection from the ravages of business. Because let's face it, business is inherently risky. We know we're in a creative industry. There is a chance of failure, unfortunately. And that failure is something that we want to ensure is isolated and quarantined. So where we're looking at a limitation of liability, it's fundamental to understand that a company is actually a separate legal entity. It's separate and distinct from yourself. That means that it can sue and be sued, own assets, incur liabilities in its own right. It doesn't have any individuals that operate directly as its agents. Typically, it's acting as its own legal entity. But it has a number of individuals that essentially work in orbit around it. And they're listed up on the screen, and we'll work through them in a bit of detail. So the first one, and the most common one, is a directorship. And so a director is the physical, tangible person who signs on the bottom line of contracts to make sure that those contracts are effective on behalf of this intangible entity, the company. The directors themselves actually sit behind what we call the corporate veil. So that is that they are separate and distinct from the company, and they're only personally liable for things typically where they've breached directors' duties. So directors' duties are quite exhaustive, and they're covered out in the Corporations Act, the governing documentation or legislation that sets out how companies operate. So directors' duties are quite diverse. They include some fairly common things that you would expect. So an obligation for the company to maintain books and records, an onus on directors to act in good faith, and probably the one that comes up quite often is this idea of trading whilst insolvent. And that is where the company has gone out and deliberately incurred debts beyond its capacity to make repayment. It doesn't necessarily mean that you have to have money in the bank all the time, but it does mean that you have to be able to meet the debts as and when they fall due, typically, which, as you can understand, often has a degree of flexibility about it. So directors, provided they do the right thing, are largely the ones that control the operation of the company. And because they control the operation of the company, they're the ones that operate the business on behalf of the company. There are some other liabilities to be aware of. So things like the Fair Work Act place penalty provisions in there for directors who fail to maintain a safe workspace, which you can understand. And then also some ATO-linked obligations. So things like making sure that you pay your employees PAYG on time, or you pay your employees superannuation on time. So obviously they're quite important. It's very easy for people to lose sight of paying those obligations, whether deliberately or indirectly in a period of high financial pressure. So it's important to be able to be aware of what those exposures are and make sure that the directors are keeping the company operating safely, or if things are going really wrong, then they can step in and appoint an administrator or a liquidator if that is needed. The second party that is involved is shareholders. So the shareholders are the ones that issue capital to the company. They subscribe for shares in exchange for the startup funds the company needs to get going. Often that can be quite a nominal amount, and for a small team, you would typically see something like $100, for example. Those shareholders, really, they're the ones that stand to benefit from the success of the company. They're essentially the company's owners, and they will benefit by virtue of the directors declaring dividends against the shares that they own in future, or perhaps if those shares are sold to another party. So as an indirect owner, they have very little say in the operation of the company. So essentially their role will be to ensure that there is a director appointed, and outside of that, the directors control the operations of the company. So what that means is you've got these three parties that are working in operation together: the shareholders who contribute the initial capital, the company who receives that money, and then the directors who deploy those funds to create the business. Sometimes there's additional money required and the directors might ask for loans, and it's quite commonplace to see a company raising funds from shareholders by way of loans as well. So that's the natural structure of a company, and provided you have those arrangements in place, then all the parties are largely going to be protected, and the risk of the business operations are going to be isolated in that company structure. It's worth noting that from a director standpoint, not everyone needs to be a director. They're the ones that have the obligation to meet all these demands of operating a company, and also the ones that carry the risk if one of these more particular penalties apply to directors. So you want to make sure that you've got the right people involved, that they're actively involved in the operation of the business and the operation of the company, and they're going to take an interest in things. Likewise for shareholders, you want to make sure that they're the people who are going to see the game through to fruition. I tend to think of a company structure as more the start of a studio rather than the start of a title, with that in mind. Once shares are issued, there's often very little you can do to extract the shares from another party. And it's worth being mindful of that, particularly if you're starting up a company with a small team who are fresh into their careers. If you give shares to someone or issue shares to someone and that person has a sudden career change, gets their dream job, goes to work for Blizzard or something like that, you don't really have a mechanism to recover those shares from those parties unless you have what is called a shareholder agreement. So the shareholder agreement is the document that sits and binds all the shareholders together. It's an optional thing. It's something that a lawyer would draw up. There's plenty of great lawyers out there. I tend to work quite a lot with Cam Rogers, who is also a member of IGEA. The shareholders agreement is an agreement between the parties that sets out all the things that aren't covered in the company's governing document, which is the company constitution. So the company constitution sets out how the company is operating, and it largely uses what are called replaceable rules that are set out in the Corporations Act. They're all worth being aware of. Certainly if you go and set a company up, if you just go directly via ASIC, you may not even set a company constitution up, whereas if you go through a setup party, they'll often provide a template document, which can be edited and adjusted. There are certain aspects that are locked in stone, and the items that aren't typically are what we call these replaceable rules. So going back to the shareholder agreement, it's a document that sits over the top of the company's constitution. It's an agreement between the shareholders, and it can set out things like, well, what happens if we need more money? How much should individuals be getting paid? What happens if we are unsuccessful, and how do we wind this thing up? What happens if a party decides they get a dream job and they want to go elsewhere? All worthy things that are worth considering. And having that conversation early is a great way to ensure that the company will succeed. Moving on from there, let's talk about this idea of an IP vehicle. So I like to think of a company being this separate legal entity as a focal point for the collation of all the legal arrangements to point all of that IP into one particular location. That's really important because when you're actually putting a game out on a platform like Steam, you'll be making statements to the platform or perhaps a publisher that all of the IP is yours, you have control over it, etc., etc. So having a single legal entity that brings all that IP together becomes really important. That's why things like partnerships sometimes struggle, because where the IP is held separately amongst different IP owners, if one party withholds their ownership, then it can make it difficult to release a game. So having it all pointed in, having all parties that are participating in the development signing contracted agreements that direct that IP up into the company becomes really important. It means that later on, when you start going through other events like due diligence, you've got the ability to collate all of this legal documentation, pull it together and evidence the IP ownership. And it also means that you can, in an ideal world, have again these conversations early so that people know where they stand, know what the expectations are, know what their rights are with respect to the IP that maybe they retain some personal interest in, and ensure that everyone's on the same page. Ultimately, when you're consolidating the IP into the company structure, what you're doing is you're creating a singular point for this IP to be dealt with. And that becomes quite helpful for portability. So if, for example, you had an investor that's coming on board and wanted to join the company as a shareholder, they might subscribe for new shares and inject funds into the company through a subscription for shares. They would want to ensure that that company actually owns the IP that the game is going to be used to produce. So you're making sure that you've got that ability there. Shares become a really great proxy for ownership of the title itself or the studio. And it means that they're quite portable. So in the instance where down the track, you have a very, very successful release, you're looking at ways to exit. there's an opportunity there to sell the shares in the company and transfer for ownership of that IP indirectly by virtue of the ownership in the shares to another party. Investors and acquirers will all be very familiar with shares. Even Australian companies are fairly commonly transacted upon. If you were looking at doing a transaction where you were assigning IP instead, then what you would need to do is take up each individual legal contract and work on assigning that contract. So you can appreciate that can be quite a challenge, and again represents why having it all done earlier in the piece is quite advantageous. Last point I'll touch on, I think because of this idea of consolidation of IP, what you'll find is that many state and federal grants will require a company to be in existence and own the IP. So certainly some of the earlier stage grants don't require that structure, but I know the second round for Screen Australia will require a company to exist. You can apply individually in the first instance, but they'll want that corporate entity up and running or a plan to see that set up. Now we'll move on to, as I said, the last and the component that's near and dear to my heart is taxation. So it's really important to understand why this is advantageous, particularly in the game space. Companies pay a flat rate of tax of 25 cents in the dollar, or 30% if you're a large company. That 25% is quite a bit lower than what you would find as the top marginal tax rate. So for a sole trader or perhaps partners, their marginal tax rates are scaled. The more they earn in a given financial year, the higher the rate of tax they pay. And that can be as high as 47 cents in the dollar. You can see quite a difference there. Paying tax at 47 cents in the dollar, once you earn over $190,000, there's quite a bit of arbitrage there between the corporate tax rate of 25 cents. So having that lower tax rate is quite important because it means the company can retain those funds from that first release and give you the funding you need to step into your next title. The more that you can retain, the better placed you'll be. If you're receiving the money yourself individually, then you'll be paying a much higher rate of tax. And it's important to understand because of the way that sales work in games. I mean, obviously there are different ways of generating revenue from games. I'll talk from a very standard release pattern. If you put a game up on Steam, you probably see the majority of your sales in the first 3 months, which tends to be quite a dramatic spike up. And then it tends to flatten out and hopefully have a long fat tail, but what you probably find is that it drops to nil fairly quickly. So that can be quite a challenge, particularly if you've got a significant release. As you can appreciate, if the revenue spikes right up quickly, then you'll be quickly pushing yourself up into those top marginal tax brackets. So having the ability to receive a lot of revenue in a very short amount of time, pay a very low or relatively low rate of tax on it, and then release those funds to the shareholders or the participants in the business over time can give you quite a significant tax advantage. It has the ability to ensure that double taxation doesn't occur because you've got these wonderful things called franking credits, reputation credits, that mean that the company tax that's paid when it passes out to the hands of the shareholders actually flows out, so they don't pay tax twice. Other tax concessions that you need to be mindful of, the big one that's industry specific, the DGTO, Digital Games Tax Offset. You are required to be a company to access this offset, and it can be quite lucrative, particularly if your budgeted spend on a release is $500,000. You might say, oh, that's quite a lot to reach. And look, that is a significant milestone. It's probably going to be a challenge for a small indie studio, but we have seen it done. It can operate over a period of years before you make the claim, but it does occur after the game is released, certainly for Certificate 1. The other element we saw a lot of in the past was R&D. I'm probably a little bit more bearish around R&D at the moment, particularly in respect of a number of ATO sort of saber-rattling taxpayer alerts that talk about how R&D in software should be quite limited. So it would really only be in the instance where you saw quite technical adaptation or development of an engine or something like that. What we're seeing in practice is probably not quite to that level and wouldn't qualify. So probably the only bit that I haven't covered off is really, why shouldn't you set up a company? And I think it's worth addressing that. Companies are expensive. They typically cost probably about $1,500 plus GST to set up, is certainly what we charge for the setup. And then I suggest to people that are starting and running a studio, they probably want to budget around $2,500 in each year for administration and management of the company. The company has its own tax return to lodge. It has reporting obligations to the Australian Securities and Investment Commission. So you want to make sure that you're able to address all those obligations. And then there'll be things along the way, things like the need to maintain books and records where you might need a Xero subscription. So all things to be really mindful of. The alternative, of course, is to certainly stay as a sole trader or partnership. And many people that are starting out will choose to do that. They'll stick together as a small group, as a partnership, keep costs low, stay in that structure for as long as they can until typically either one of two things occurs. They're looking to get access to a grant that requires them to be a company, in which case it's worth starting then. Or if IP arrangements start to get complex, certainly before you release, you would like to be in a corporate structure. If you release a game and make a lot of money quickly, there's very little we can do to get a company in place. And that's typically because you're registering the actual company with the distribution platforms that are there. So you want to make sure you've got that structure up. There's a natural tension there between how quickly you start incurring the costs and how soon you start getting the benefits of a company. That's really all I had to cover off. I might jump across if anyone has any questions.
Yes, please put them in the chat and I'll relay them back to Luke. But thank you very much, Luke, for your presentation. That was very illuminating. Because, I mean, it is so important, right? Like, I never forget how I was talking to a group of students after their graduation ceremony and asked them, what are you going to do next? They're like, oh, I don't know, maybe you're going to apply for funding for our game. It was a great game. I'm like, oh, okay, yeah, good on you. But have you thought about the company structure? What's going to happen if it doesn't quite work out? And then one of you is working at Woolies and it's like, you know what, I'm out of here. But then the game becomes a success. All of that becomes very difficult very, very quickly. All right, so we do have a question here. Hi, Luke, thanks for the insight. What IFRS/AASB standards are most relevant for games/software accounting?
Look, that's a really good question. Probably a little technical from an accounting standpoint for most of the audience. The AASB standards are the accounting standards that are typically operated and are documented in Australia for how what sort of accounting policies that we should use. Look, we don't tend to apply a lot of them, particularly for small studios. They're not particularly relevant until you tend to start needing to deal with international parties where there is a need for a common accounting standard to be agreed. So for the most part, we'll use what we call generally accepted accounting principles. So very simple accounting, debits and credits. Sometimes you might find that the AASB or IFRS standards step in and become relevant, and that can often be, particularly as a studio starts to get bigger, it might start to track things like leave entitlements for employees, because they can be quite significant if you have a significant number of employees.
Yeah, excellent. Thank you. Another question here from the same person. I read that there's been a push in the Australian Parliament to allow for the full expensing of R&D for software firms. Is that still active or proposed? Look, I don't know how your grapevine to Canberra is, but maybe you do have some info.
No, I haven't heard a lot around that. I probably deal more with software at the coalface, and the main instrument that you find you're dealing with there is the ATO. I have 2 active audits with the ATO that have escalated from reviews for companies that have undertaken R&D in the software development space, and the ATO are quite aggressive in pursuing them. Unreasonably so would be my view. So what you might get is a bit of doublespeak from Canberra, where they're encouraging things, but the practice when they're also increasing the funding to the ATO's review capability teams is a little different. So look, R&D is a great space, but I think the DGTO, assuming people can reach the thresholds, not only is it going to be dramatically easier to apply, it also is financially gives a better net outcome.
Yeah, that's right. Speaking of the DGTO, we do have a question in the chat. How does it actually work?
Wow, how long have we got?
Yeah, well, maybe just sort of on a high level. Because one thing to keep in mind as well is that the threshold of that is $500,000, right? So you're going to spend at least $500,000 on eligible expenditure. But I'll let Luke take over from here.
Yeah, that's right. So it works on what is called QUAID. So it is linked to the expenditure of the studio. QUAID is quite narrow, but when you think about it in practice, it's actually covering the vast majority of the expenditure that you have. So it covers things like wages, superannuation, work cover, and contractor payments. They're the main elements. Contractor payments can be limited in certain circumstances, particularly if there's subcontracting involved, and all of that expenditure needs to be linked to Australia. So they're flowing to Australian employees or down to Australian contractors. That's probably the main thing to be aware of. There are a series of certificates that you apply for. That's done through the Office of the Arts. I'm actually an assessor, or my practice is an assessor for the Office of the Arts. And those claims are put through, and then there's a review of the expenditure that goes on to make sure that everything's accurate and comfortable before it goes off to be signed off by the board and then the minister. There's three main certificates for the audience. The first certificate is probably the main one, which is Certificate 1, which is the covering the cost from the commencement of development through to the public release of the game. Certificate 2 for completeness is for porting, and Certificate 3 is for ongoing operation, so sort of live ops and that sort of thing.
That's right. I also put a link into the chat with an old webinar that we've once ran with the Office for the Arts that may answer some of your questions as well. All right. It seems that Luke's camera. There he is. All right. So we have a question here that I'm sure is relevant for a lot of studios who are just starting out. Namely, how do you approach working with someone on a game on a revenue share arrangement, but not involve them in a company that is already set up?
Look, it's a really interesting one. Revenue share is quite a common arrangement within the industry, simply because cash can be tied up front. There's two things to be aware of with revenue share arrangements. The first is that the fact that someone's a willing participant to a revenue share arrangement doesn't override minimum employment standards. So if, for example, the person you're engaging is not themselves operating a business, they're not running a business as a contractor, and they would be, by all intents, an employee, then you still have to meet minimum pay requirements. So revenue share doesn't always address that aspect. And the onus is on the employer here, even though the employee may be a very willing participant. The second piece is for international parties. So if you do sign revenue share agreements, revenue share is typically for the utilisation of IP, and the payment to that party would be classed as a royalty. And that means that where royalties are paid between different tax jurisdictions, so different countries, they'd be governed by the double tax agreement between the countries, and there'd be an onus there on you as the payer to withhold tax, so withholding tax for Australia. So it's worth being aware of. Look, I think revenue shares agreements are a practical piece. I don't think they're my first choice. I think your better arrangement would be to try and secure funding of some description and get people on at least a minimum income share or minimum remuneration that covers off the basics, and then look at revenue share as a sort of a cherry on top. You do need to be very mindful with revenue share arrangements that the more you carve off, the less it's left at the end. And we have seen those arrangements sort of turn sour. There's not enough left to really sustain the studio into the next title.
But I also appreciate your point about the minimum employee standards. So slave labor, not an option.
No, it's not.
Worth stressing, I suppose. There is an interesting comment here, and a valuable comment from Alex in the chat. More advice than a question. Some game platforms don't let you edit developer accounts to change entity type. So if you switch from sole trader to company, keep in mind the effort and time you need to get your game sorted out smoothly. Good point. That, for example, applies to the Steam app, Nintendo account registration, and so on. So just something to keep in mind, worth doing, but there may be a couple of ramifications later on. We also, and I don't know, Luke, if you can answer that question, but we do have a question in the chat. What is one of your most interesting deal/client experiences? I'm sure there is some sort of confidentiality here, but I mean, is there maybe something where like, oh god, that's a pitfall people, often fall for, and I've seen it end in tears, without naming any names. Remember the disclaimer at the beginning.
Yeah, look, that's a terrific one. There's lots of weird and wonderful things that we've come across, and that's part of the reason why I love working in games, because it's far more interesting than another bloody doctor. So, look, there are lots of interesting things. I think the important thing, and I've tried to stress that through my talk, is this idea of having conversations earlier in the piece is really important. The more you can cover off and make sure you're all on the same page, I think is a great way to set out and minimise the risk of dispute happening down the track. You have certainly seen a number of studios here in Australia that have gone through what we would consider, I won't use the term Phoenix, but essentially combusted because of the liabilities that are there, and then restarted the very next day. And look, that unfortunately is a bit of the nature of the industry. We know that there's risk inherent in any creative pursuit. So it's worth being mindful of that. There's certainly a lot of people that are characters that will perhaps have a one-off success who become lionised for that. And all I'd say is that if anyone had cracked, the secret recipe, they'd be doing successful, outstanding releases every single time. I don't know that anyone does that. If they do, maybe let me know. That'd be great to have them as a client.
Yeah, I know. Right. Well, we'll feature them in the webinar, and then we can all spend the rest of our working lives on a yacht, or rather, non-working lives. All right, look, we have time for one more question before we go to the marketing talk, and that is, what is needed to move from a sole trader to a company? I mean, you sort of talked about this before. I think it's worth stressing this one again, because it's such a crucial step in terms of what it can do for you, and also what expectations from a screen agency are.
Yeah, look, you certainly want to speak to an accountant about it and make sure that someone's helping you with the setup. You can go and do it yourself. That's certainly feasible. I appreciate that as a professional, we have a cost, and that cost can be more than what people want to spend. But I'd like to think that getting it done right from the start is very helpful. From the transition from a sole trader to a company, probably the main thing is just making sure that you've got that IP assignment done. I think later on the legals will want to make sure that that's in place, so you've got that clear chain of title. But look, honestly, you should reach out and speak to people, have conversations. You've got my contact details there. I'm happy to have a chat with anyone, not without any sales pressure, but it's good to talk games and explain some of these concepts, because otherwise you don't get exposure to them through your courses. And likewise, build a connection with lawyers and perhaps other successful studio owners as well. They're all good people to be able to reach out to and just have a conversation with.
Yeah, absolutely. I was just going to stress the lawyer part as well. That is also worth looking into. Otherwise, you may be paying later down the road if you don't have things locked in properly. That is a worthwhile expense. Same with accountants. They're here to help you. And we're not just featuring this talk for marketing purposes, but it's a genuine service that is genuinely useful to you. Look, that is all we have time for when it comes to setting up companies. There's lots more to talk about, but at least it gives you a bit of an idea as to what that entails and some of the steps that you need to take. Luke, thank you very much for joining us today and walking us through that. It's greatly appreciated. As a next talk, we are going to talk marketing. For that, Kate Hall from Play Indies is going to join us. All right. Well, Luke, thank you so much. Take care. See you later. And we are going to hopefully switch over to Kate.
Thanks, guys. Have a great day.
Yes.